Hello and welcome to Big Deal. Now, we are seeing an IPO frenzy in the startup world. Many opine that 2021 could be the year of these unicorns as well as unicorns to really join the listed brigade in their hunt for capital and provide exits to the venture capital investors. On Big Deal today, we discuss the entire funding ecosystem for the startup world, with equity and even debt playing an important role there. And we have with us Ajay Hattangdi of Alteria Capital, Bejul Somaya of Lightspeed, and Raj Balakrishnan of Bank of America. Gentlemen, so good to have you on CNBC TV 18. Ajay, starting with you, because this is a differentiated space that you provide. Startups are not known for the debt funding requirements. What is the scope for your kind of product in the startup space as we see bigger and bigger companies coming to the fore?
Yeah, always a pleasure to speak to you, Nisha. Debt, it's a little bit strange to talk about debt in the context of startups, but debt is a very important component of the overall sort of capital structure of any company. I think what makes it challenging, obviously, in a startup is the fact that there's oftentimes very little cash flow and there's no overt forms of collateral that lenders can typically take. So you're right, it's a very specialized form of lending. That said, it has been a part of kind of the venture ecosystem now going back in the US about 40, 50 years. And in India now, it's been around for about 15 or 16 years. And essentially, it involves working very, very closely with the VC investors in identifying companies that can really scale and then providing them with some kind of debt capital in addition to the equity that there is, to provide them with that extra amount of capital to give them the ability to kind of open up their arms and run harder, faster, longer, and thereby improve and increase valuations ahead of the next round. So typically, when you think about venture debt, you think about typically Series A, Series B, Series C types of companies earlier in the life cycle as they're starting out to get their first round of institutional capital. And then the debt goes in to kind of help them supercharge their business and give them more cash runway. So it's generally a proposition that works very well for a company that's raised a cushion of capital from an institutional investor, and then a little bit extra on top of that to give them that additional sort of gas in the tank. So I think one of the things is that, is as companies are now, as you said, growing, getting larger, as a lot of these companies that started out 5-6 years back are now maturing, getting to a stage where they're larger now. They're reaching, unicorn status. Obviously, the needs for capital for these companies has grown much more. And, the role of debt, I think, is an important one where it goes to, helping some of these companies add to the equity that they've got in meaningful ways. And of course, the challenge for us as lenders is how do we continue to stay relevant to some of these companies as they grow from companies that are younger and building out and starting at the start of the life cycle to companies that are now scaling up to significant levels. Because at some levels, the availability for debt kind of thins out as companies grow much larger, because venture debt is just one part of the equation that a company has to solve for as they grow through their life cycle. So I think, right. So venture debt works well early, and I think it's something that we have to keep an eye on as some of these companies get larger as they just go through their life cycle.
That's right, Ajay. And in fact, what we used to say pre-NPA era in the country, that larger the company, larger is the debt amount. Now, not so much after what we have seen in the last 6 years. But I'll come back to you for more on the nitty-gritties of your business and what you can provide. Let me first take it straight across to Raj Balakrishnan, who's really there at the front foot, pitching for the IPOs in the startup world. There is a frenzy that we are seeing. And as Raj, the startup companies try to really hop across to the traditional listed space, first I want to ask you, how much of an impact will the market volatility and the recent concerns because of the resurgence of COVID cases has really caused, and what will it really mean for the IPO ecosystem, not just in startups, but across the board?
So I think the resurgence of COVID cases will not make a material difference to the IPO ecosystem. And I think that's driven by the fact that, yes, we are having a spike. We probably had seen a false bottom, to use a market phrase, in terms of case counts. But I think we've already crossed, if I'm not mistaken, 5 crore vaccinations, with vaccinations being opened up to the over 45s, hopefully very soon for all adults. I think what you will find is that at least in urban India, virtually everyone will be vaccinated in the next 3 to 4 months. And therefore, I think we are closer to the end of the COVID period than to the beginning. And ultimately, what people are looking for is the bounce back in the economy that we all expect going forward, which obviously bodes well for IPOs and capital markets more generally.
So still a note of optimism from the CM trade side and the equity market side, Raj. But we have to discuss a lot more about what's really happening when startups really come to the equity market. But Bejul Somaya also joins in from Lightspeed. Bejul, how do you think the startup companies are going to perform in the traditional market space? What do you foresee here?
Well, I think the first point, Nisha, is that COVID has really accelerated almost everything digital. And so the startups that we're talking about operate in the digital economy. They're creating the digital economy. That was underway already pre-COVID as a result of a lot of investments that have been made in digital infrastructure by companies like Jio, as well as other government initiatives to really drive digital adoption, whether in payments or otherwise. So we were already accelerating in terms of building the digital economy. And then with the pandemic globally, what you've seen is an acceleration of technology adoption. And so that's really driven a lot of growth for technology startups, consumer startups. There's a lot in education, obviously, that is changed. We're beginning to see real changes in the healthcare ecosystem, as well as in the software and SaaS ecosystem. And so as a result, I think right now the technology startup world is having a little bit of a moment in terms of growth, optimism, rising valuations, which is sometimes it can seem quite disconnected from obviously what's happening in the real world.
Actually, it's a wrong nomenclature in itself, startup, because most of these companies have really attained the size and scale, which, of course, you named it, digital revolution has really provided them with. But Bejul, I can't help but ask that you have some of the marquee companies who are unicorns or sunicorns in your portfolio. Are you looking at this IPO opportunity in the local market as well for your portfolio companies?
I think it always makes sense to consider and think through environments like these that present themselves for companies to access further financing. IPOs are really just one way for companies to raise additional capital. Obviously, the private markets also are very robust right now. So I think all companies would in general think about what is the right financing strategy given the state of the current markets. It does look like, given the scarcity of large internet Indian companies and digital companies in India, that public markets would really be very receptive to these kinds of companies. So that is something that we're considering, and it would be remiss not to consider that given the current market environment.
All right. And Raj Balakrishnan, do you think that, Indian local markets are giving the kind of understanding and maturity that is required for these digital companies? Or do you think that it's a dampener that we haven't really come out with the global direct listing for which the startup world was waiting with bated breath?
So I think when you talk of digital companies, it's a very wide spectrum. There are some companies which are much closer to consumer names. And if you're looking at a typical consumer name, there's no market which gives better valuations for consumer stocks than the Indian market does. So if I were a consumer-oriented digital company with a very strong consumer brand in India, I would much rather list in India rather than anywhere else. There are other companies which perhaps are focused on much more like analytics, SaaS, some of these other spaces. or moving away from the digital world, things like biotech, where probably the understanding is far deeper in a market such as the US. And so for those companies, obviously listing in the US and the direct listing route would have been a more attractive path.
Right. And Bejul, what do you have to say when we really compare the opportunity that SPAC has presented, which many of these companies are really evaluating at this time? Of course, the externalizing is a difficult bit. The structure is not easy. Global direct listing norms haven't come, but some of these companies have a huge amount of foreign offshore, stakeholding as well. So that is easier. But on the other hand, the IPO market and the local market. So how do you really assess the comparison between the three avenues?
Yeah, I think the point that Raj made is really important. The idea being that there isn't a one-size-fits-all answer. So, for example, SPACs might be more suitable for companies that, in fact, may find it harder to get public, given where they are today, but where the long-term vision of the company and the long-term potential of the company is really very, very compelling. So I think it's really important to think about what are the specifics of this company. As Raj said, if you're a consumer company that's profitable or nearing profitability, it makes sense to get public in India. If you're more of a high growth technology company, probably makes more sense for an overseas listing. If you're a company with, where the data is not there today, but the vision is very big, the momentum is very strong, but it's going to be a longer term trajectory, it may make sense to evaluate SPACs, which, as you said, still is a number of hoops to jump through for Indian companies. The other thing to just keep in mind is, while one can be tempted to be opportunistic with respect to SPACs, ultimately this is a path to the public markets. So you have to think about whether a company is ready for that, because once it is public, there's a different set of behaviors that you have to live by, as well as public market scrutiny and information disclosure, and whether or not that makes sense for the particular company.
That's right. So you focused on all the aspects except the valuation dynamics. In fact, we'll slip into a short breather on that particular note and come back with more on the valuations and many other aspects of the funding culture in the startup world. Stay tuned to Big Deal.